All right, welcome everyone. This is the fifth episode of the Canadian Investors Podcast. My name is Kuhn. I'm joined by Jake, Nate, and Tom. Today's topic is Alibaba, and Jake will be the one presenting the bull case, I suppose. And we'll start with a bit of self-introduction. I'm an accountant by training, and now I teach university. I teach financial accounting and managerial accounting. Now, my investment philosophy is I want to identify growth companies that are these long-term compounders, and I use my accounting and other technical knowledge to identify red flags and just to see whether this story is intact, and B, obviously to verify if growth, right, as I reported in 10 case, is actually growth, not something else. So with that said, I'll pass on to Jake.
My name's Jake. I'm an electrician by day. I've been investing for about 10 years now, just a retail investor. And I focus on mostly value investing by discounted cash flow calculations. And yeah, I'll pass it on to Nate or Tom.
I can go. I'm Nate. I'm a school teacher, and I look to find high growth companies at fair or cheap values, and I tend to focus on more of a quantitative approach than a statistical analysis approach.
Regular retail investor with mostly a background in real estate and real estate investing and stuff like that. And I've just been working for many years towards financial independence. Yeah, that's it.
Awesome. I guess we could also start with at the beginning, who actually owns the stock. So I do own some Alibaba shares. It's not my biggest position, but it's not inconsequential either. And Jake is a shareholder as well.
Yeah, I hold some as well.
My take is Nate and Tom does not own it.
I do not own it, no. Never have, and no plans on buying any.
Not yet.
So 5 episodes in a row, I think I own all the stocks. I don't know if I'm just not. I'm not very I'm not very focused, or I feel special. All right. So
you don't own a lot of stocks, do you, Kuhn? Like you're like the most concentrated.
About 35 positions. Some of it are REITs, so like these are not necessarily the ones I want to focus on. But let's get on with the presentation. Jake is gonna give us a deep dive into Alibaba.
Yeah, I'll start sharing my screen here. So I only have a few slides here just to give a brief overview of what Alibaba is. But they were founded in 1999, and their original goal was to last at least 102 years, spanning 3 different centuries. Before I start too, I just wanted to point out that I'm a firm believer that every single valuation has bias, no matter what the method. The only question is how much and in what direction. And like we just went over, I do own shares in Alibaba. So despite my best efforts, I'm probably going to have a positive bias towards it. So they could basically be broken down into 5 main segments, which is core commerce, cloud computing, digital media and entertainment, logistics, and innovation initiatives. They also have a 33% stake in Ant Group, which offers digital payment and financial services. Core commerce can be further broken down into China commerce, international commerce, and local consumer services. Here's an interesting photo that just shows how big they really are from their investor day. These are all individual businesses under each segment. I don't know, I can't say half of these, but it just shows you how big they really are. Most people in North America are probably familiar with AliExpress or wholesale. So for the China commerce, it's the most valuable and largest consumer base in China. And it's responsible for 70% of Alibaba's total revenue. So it's by far their biggest revenue source. As of the last quarter, they had 979 million average annual consumers. They did 71.3 billion US in revenue for the trailing 12 months, which is 22% growth year over year. They have 90% market penetration among consumers 15 to 24 years old, which is pretty crazy. And I think that should really benefit them going in the future as those consumers get older. They're really focusing on expanding to lower tier cities and increasing order growth. Right now, I think they have like all of the tier 1 cities covered. This is one of the things I think is the most exciting about it, just how quickly China has been growing in GDP per capita. You can see they still have a long way to go to meet Canada or the US. But if you look at the annual growth rate, China has been by far above them.
This is 1990 to 2020.
Yeah.
Okay. Yeah, just
I don't know if you could see this side of the screen or not, but
Yeah,
we
we can
could.
see
Yeah,
it.
I'm just saying that for maybe people who are just listening, we may want to just
oh yeah.
not completely rely on visuals, but
Yeah.
these are awesome information.
Yeah, I'd like to point out though, comparing China's growth rate since like 1990 as a percentage is sort of, to grow 12-13% from such a low base is a lot easier.
Oh yeah.
Just because
Absolutely.
of you're starting from smaller numbers. It's a lot easier to grow. I think originally like a $2,000 GDP to a $10,000 to $20,000 GDP than it is for like 40,000 to go to 60 or 80,000.
Yeah, absolutely. But you could see the trend that they seem to be catching up quicker than they're growing. But yeah,
I think
you're
that's kind of
absolutely right.
natural when you think about it too, right? Like that's always going to be the trend when we look at developing countries versus developed countries, right?
Yeah.
So then going on to the international commerce, they had 301 million average annual consumers, which was up 16 million this quarter. Average order growth is also up 25% year over year. They had 46.7 billion in revenue over the last 9 months, which is up 32% year over year. I didn't have time to do the trailing 12 months for any of these, so I just based it off the trailing 9 months, which is what they show for some reason. So they've been heavily investing in Lazada, which is their e-commerce platform in Southeast Asia. And they expect that to be a large reason for their growth going forward. Most products sold on Amazon are actually sourced through Alibaba. I don't know if most people knew that or not, but
yeah.
I think people are probably aware.
probably.
Some people, I don't think most regular people know that most of the stuff is bought from Alibaba.
Yeah. You know what? For the longest time, I didn't even know Amazon had third-party sellers.
Oh
yeah, I think a lot of people don't know that it's actually mostly third-party sellers on Amazon.
That explains why most of it's lower quality.
Yeah, especially if you see, I don't know if you call it knockoffs or what. As consumer electronics, I do tend to buy quite a bit on Amazon, and you notice a lot of products look exactly the same, even though they have different brand names, and the brand names are kind of like use a weird English word or not even. Right, so all of those come from Shenzhen, I think. From maybe even from the same manufacturer, and so different retailers slap their label brand on it. Yeah, I'm not too sure. What's interesting is I don't know, like how much margin Alibaba makes on the sales to Amazon retailers, right? Obviously, the volume is tremendous.
Yeah, because I think Alibaba isn't actually selling their own products either. It's more of like a way for you to link up with different manufacturers in China, and they act more as a like a third party intermediary between you and the manufacturers. Because I have a friend that is doing the Amazon thing right now, and they had to go and negotiate with all of these different companies on different products and how much they're going to pay and shipping and stuff like that. And Alibaba's more of like to make sure you don't get ripped off.
Yeah, that's right. Yeah. So this is one of their main growth strategies going forward, being that they already have so much market penetration in China. They're trying to expand more internationally. And then the local consumer services is their digital platforms that link users with offline lifestyle businesses. As an example, virtual drugstores that deliver prescriptions or ordering food. They had 350 million average annual consumers last year. And that order volume growth has grown by 22%. They had 5.2 billion US dollars in the trailing 9 months, which is up 21% year over year.
And this is, sorry, the year over year is 2021 compared to 2020?
Yeah, it's the 9 months ending December 2021 over 9 months ending December 2020.
Awesome.
And then they're going on to the cloud computing. Revenue for the December quarter increased 20% year over year, despite losing their top customer, which was ByteDance, which is the owner of TikTok. I'm not 100% sure why they lost them, why they left. I assume they just went out on their own, possibly. I'm not sure. Non-internet industries accounted for 52% of their revenue, and they're finally profitable in their cloud computing. They were unprofitable for many years, but the last 3 quarters now they've made profit.
That might be due to stickiness, eh?
Yeah. They did 8.7 billion US in the trailing 9 months, which was up 27% year over year. And they have 38% of China's total cloud market share, and that has been growing as well, despite competitors creeping in. And the China's cloud market is expected to grow 40% per year till 2025, hitting 154 billion US. So even if they went down to a 20% market share, that would represent over 30 billion in revenue, if that's accurate. Well, I'm gonna screw this one up. How do you say this word? Sinow?
I thought Kuhn was going to help you with this.
Yeah, me too. Where is he?
I was just busy eating a sandwich, but yes, the pronunciation, it's Cai Niao.
Chino.
Good enough. Yeah,
Okay.
good enough.
I was going to say, I'm pretty sure that's not what he said, but
Tainao is Alibaba's logistics branch anyway. They aim to deliver a package anywhere in China within 24 hours or 72 hours globally. They have over 10 million plus square meters in assets and storage areas. They've seen over 88% daily package volume growth. And over the last year, they've delivered 64 million packages per day on average. Revenue of 34.5 billion or 5.4 billion US over the trailing 9 months, which is up 26% year over year. And they're still losing money. They lost 14 million last quarter. I should point out that I think every segment is so far losing money except for China's commerce and cloud.
I think cloud is also, maybe cloud is breaking even, right?
They've
Last time I
made
checked,
profit last 3 quarters.
Oh, I see. Okay. Yeah, it is quite different. I just want to bring up this comparison to Amazon. It's I mean, you could say they're in the same business segments, right? But Amazon's main cash cow is AWS, right? The cloud business, and which Alibaba is trying to grow. And Alibaba's cash cow is their e-commerce business, where even though Amazon started with their e-commerce business, they never tried to monetize it as heavily, right? Like I think it's, Amazon could be very easily be just breaking even on their e-commerce, and they just keep growing. So part of the valuation, and I guess what makes people think differently about Alibaba is like, okay, so how long is this cash going to last for Alibaba versus what's the competitive advantage of AWS when they're trying to grow the other side of the business, right? To look more similar to one another.
Alibaba also owns a 33% stake in Ant Group, which is kind of similar to Square or Block, what we did last week. They're a digital finance solutions company. It was also created by Jack Ma. It includes Alipay, which is the leading digital payment platform in China. It also has services such as consumer credit platform that offers buy now, pay later, banking, independent credit rating services, and saving services. China's digital payment transaction volume is expected to surpass 61 trillion US by, I can't see the side of the screen, 2025, I think.
Right. We can see it if you can't.
Yeah.
Oh, okay. It was supposed to be the largest IPO ever, being valued at over 300 billion US, but the Chinese regulators scratched that after Jack Ma criticized them publicly. So it's still on hold now, and I just saw that now it's on hold indefinitely. So we'll see if that ever happens.
Wow.
But the last I saw, it was now valued between 100 and 200 billion, and it's probably even lower now. But Alibaba still receives the profit of it every quarter. So they've received 2.6 billion over the last 3 quarters, and for the fiscal year ending March 2021, they received 3 billion in profit.
Wow.
So I put down a few risks here that I know everybody has. I don't know if we want to talk about these now or not.
Yeah.
Unless
Competition.
Kun, do you
Yeah,
have
I think that's the neat here is that nobody doubts that Alibaba runs a good business. It's just like, okay,
Yeah.
how much damage can we expect from the regulators and the markets and all the uncertainty associated with it?
I actually have some questions about the growth personally too.
Okay.
Well, it's related to these, right? I mean, if the regulator is not going to give Alibaba the ability to expand as they wish, that's going to hurt their growth.
Just out of curiosity, Jake, what did you put your growth rate as for this company?
Let's see here. I got my discounted cash flow calculation on this, which isn't completely accurate, but I put in 19% for year 1, 13% for years 2 to 5.
That's pretty similar to what I have actually.
Okay. And what did you come up?
I have a predicted growth rate of 15%.
Okay. Yeah, if we look at like the revenue as a whole for Alibaba, you could see like how fast it's growing over the last 5 years. We're up to 130 billion in revenue, US, which is 37% year over year. So the big question, like you said, is how much damage is the regulators going to have going forward?
Yeah.
So who wants to start with the concerns of the regulator damage?
Okay, so number one, Jack Ma, where is he? He all of a sudden suddenly retires after speaking out. Like, the other day you guys were saying, in terms of, what was it, the $2.6 billion fine for anti-competitive behavior. I could get that, Google and a lot of our big companies have received similar fines, but like, show me where the government has ever ousted a CEO and basically stopped, like, we don't know what happened. And then also we have, it was, I believe, let me just pull up here, I had a screen open. In 2021, September 3rd, I don't know if this was the actual day that they did it, but they donated $15.5 billion, representing more than a third of their cash pile, to what they said as putting towards common prosperity, which, sort of echoed very loosely the same type of messaging from the Chinese government. So was this like an actual donation that they gave out of the goodness of their heart, or was this some backdoor punishment, do this or else?
It was
Right?
it was definitely a backdoor punishment, because other companies did the same thing, and there was reporting on it at the time, basically saying that they were told by the government that they would have to do this.
Or else.
Yeah, they or else wasn't said, but it was basically, it was the most profitable companies were told, for the good of the country, you have to donate this money. Which, like, I'm a very left-wing person. I actually don't have a problem with that on like a government policy side. Where I do have a problem was that it was just mandated to specific companies, and that there's no way to predict that risk as the investor, because it's not like a specific policy. It's just like the government's like, our coffers are a little empty. Such and such companies, you have too much profit. Donate now.
Yeah.
I don't know how you, as the investor, prepare
Yeah.
for that.
That 15 billion was over 5 years.
But it was still something that's not predictable in the future. At any time, a company's as good as its retained earnings over time. And if all of a sudden those retained earnings can just disappear unpredictably, what are those future earnings worth if they're taken away? Right?
I don't think you have any idea, really.
If the company grows at, let's say, 20% and keeps growing and has all of these retained earnings, and then all of a sudden, poof, half of it's gone, then that brings your growth rate down to what, like 10%, 9%, 8%. And then at the same time, do you honestly think that the Chinese government will ever let Alibaba distribute earnings to American investors?
Well, they're buying back shares.
But you don't know.
Yeah.
So you're not really owning the shares. Like,
well,
how
they
does that
could
work
still
through
buy
your
it back,
VIE?
right? So you could still buy it back and you can sell it. Okay, so I mean, that's one thing. You guys want to talk about growth, and I guess taxation or inadvertent taxation is related to that. Then we can talk about the VIE and delisting stuff. I just want to bring some context. Not like I'm a big fan of what the Chinese government is doing. So like Jake said, it's 15 billion over 5 years. It's mostly these are not directly paid to government, but rather they are building up their the less developed country, villages, and I wouldn't call it villages, but counties, the infrastructure to allow e-commerce to be done over there. And of course, the road to profitability to returns on these investments very, very long, right? So you could consider that type of taxation, no problem. The problem, I guess, at least on the surface, is they're saying Alibaba and other big internet companies are engaging in anti-competitive behavior, right? For example, like consumers and the merchants have to choose one or the other. I think merchants mostly, they either have to go JD or Alibaba. You can't be on both. And then it says, oh, you can't do that anymore. And JD had this alliance with Tencent. Tencent owned a lot of JD shares, at least at that time. So JD was leveraging Tencent's platform, and Alibaba was doing their own with Alipay, and it's very hard for smaller players to get in. So now they're saying, okay, so you can't force merchants to do that anymore. And subsequently, actually, Tencent have divested JD's shares, right? I think they give out like this very weird stock dividend, basically give Tencent shareholders JD shares, and you can do whatever you wish. So yeah, you can see how Tencent and Alibaba, being the two biggest companies in China, are reacting to the government pressure. Who knows where it will go from there, but at least there is some pretext.
I think you gotta like we gotta be honest here. Like in the West, there's a huge bias towards or against China. Like I did an education paper looking at different countries and ranking their education scores. And like all of the China consistently has the highest education scores in the world, and yet most reports on education will not include China. So there's obvious bias in the West, but at the same time, like there are real concerns as an investor with how China regulates businesses, in my opinion.
Yeah, for sure.
Yeah,
So,
like I think
so I never got the Jake was asking. Oh, sorry, Nate was asking Jake for his growth rate,
Oh, he
year
did
on
get
year
it.
growth rate.
You said 18%, right, Jake?
For the first year, and then for years 2 to 5, it was 13.
Oh, okay. Yeah.
Holy
nine-
cow!
Yeah, which I think is pretty conservative, but depends on where you look for analysts. I think that's very conservative. I think they'll outperform that, but I also want my valuation to be conservative as well. So
Yeah, that's a good point.
But well, I just wanted to say one more thing about the $15 billion donation. I do agree that it was definitely forced by the Chinese government, which is crazy. But in the big picture, it's 15 billion over 5 years, so 3 billion a year, when they're sitting on 77 billion in cash right now. So like big picture, I don't think it hurts Alibaba's valuation. I know they can continue to do that going forward or add more donations, which would hurt it. But big picture, the 15 billion itself, I don't think has a huge impact on it.
I think it's more the idea that they did
the principle of them doing it more so than the amount of money or how many years it was over. It's the fact that they did it.
Yeah,
and for me, it's not even really the philosophy of doing it, it's the arbitrary nature in which they did it. If they just want to say moving forward, this is a tax, then it's fine. You count for that in your valuation.
Exactly.
You can't count for it if it's not planned.
The one thing I do like about it though is that they tell shareholders where the money is going. So they're saying like what areas they're investing in, and how much money they're putting there, which is kind of nice because then you know it's actually going to the Chinese.
That's cool.
Well, you don't know that it's actually going there. You just know that that's what they've said they're doing with it.
Yeah.
Right.
That's true. Fair enough.
Yeah. So I think the fact that the Chinese government did that, and the fact that we don't have like a set rules, everything is so much like in gray areas, especially with the VIE structure, that the government's allowing it for now, but they might at some point not allow it. There's no like black and white, okay, here are the rules that you got to play by, and then you can break down and play by those rules or not, right?
Does somebody want to sorry.
Yeah, sorry.
I was just gonna say, does someone want to explain the VIE structure to the audience?
Jake?
I don't know if I'll do a good job explaining it, but so it's basically a workaround so the Chinese companies can list in the US basically. But I do want to point out that
so when you buy Alibaba stock, you don't actually own shares of Alibaba. You own a holding company that I believe holds shares in another holding company that holds shares in another holding company that has contracts on shares that are owned by another company. So like you don't really have any rights as a shareholder.
Like you can't vote on.
You can't vote, you can't sue them. Like, I'm sure we've all seen like companies that have dropped and you have all these lawsuits against them. If you lost more than $100,000 in this, join this class, like there's no accountability to shareholders in any sort of meaningful legal way, right? If they decide, hey, we're just going to cut up all of these contracts and you lose 100% of your investment, there's nothing you could do about that.
So here's my counter to that. First of all, I think the workaround exactly easiest way to think about the VIE structure. Things that investors should be aware of is that, so if you buy the BABA ticker on New York Stock Exchange, it is shares of a Cayman Islands holding company, like Tom said, and that company has owns shares in Alibaba Hong Kong. So basically, it's the same thing. If you buy the, I think 8866 Hong Kong listed shares, it doesn't remove the VIE structure risk, because the Hong Kong company merely has a contractual relationship with Alibaba China. I guess, there's a lot of regulation or laws in China that are very antiquated. Back when they were communists, just like the Communist Party like to call them, the Communist Party can't change their name, but a lot of capitalism is in China, that's for sure. So yeah, so foreigners cannot own Chinese companies. That's basically the law. And to get around that rule, a lot of companies, like including JD or Tencent, they have this VIE structure. So if Chinese companies do, the lawmakers do say, well, you can't do this VIE companies anymore, we're going to cancel all the shares. Yes, you're left with nothing. Now, we just have to think about what good does it do the Chinese government if they are ever to use a nuclear option. There's basically, like it's economic nuclear option, right? So they will say no to foreign investment forever, right? No one will ever invest in China again. So the fact that Tom said, hey, this we can't use our normal legal mechanism to back us up, but really the implied threat of basically totally cutting off the West, cutting off the rest of the world, basically. You don't know who owns these shares from China. Seems there's not much upside with the government doing this, right? So yeah. You want the president, but I don't think you should totally just kind of discount these things.
I think not much upside is thinking from our traditional capitalistic mindset, right? Sometimes you have world leaders who their framing is different on the world than what we have here in the West. And for us to fully grasp and predict that, and some of their decisions might not be money related, might be more idealistic related in terms of their philosophy on how they want their country to be run, right? More so than, are we going to make money off this?
I tend to agree with Kuhn for the most part, although I think we have one giant risk factor here, and that's just that the current president has sort of hinted that he might invade Taiwan. I think the situation in Russia actually makes that more unlikely, but I think you can't discount the possibility altogether that China is going to invade Taiwan in the near future. And then I think if that happens, then we risk all kinds of financial warfare, basically, between the West and China, because I think that will be the response. And I think that, to me, is actually the biggest risk for holding Alibaba, not even the regulatory risk.
But I personally, I think that if China were to invade Taiwan, due to Taiwan and like the semiconductor industry and our heavy reliance on it, I don't think that we would be as
insulated.
No, we would so we're not really helping Ukraine, the West, with like on the ground troops. I think to defend the semiconductor industry, I think the military would step in.
I actually think it's less likely.
You think it's less likely?
Yeah, well, we're just so interconnected with China as economies that I don't think, and Russia's military gets over exaggerated. Like it has a lot of nuclear weapons, but their army is not very advanced. It's not that large in terms of like actual well-trained soldiers. Like look at they're struggling to take Ukraine, which is a small country in terms of wealth. Like their economy is roughly the same size as Canada's, Russia, whereas like China's like the second most powerful economy on earth and has invested a ton of money in their technology. Like there's no war with China. Like that can't happen. The consequence would be so disastrous for all parties involved.
Yeah, I just want to offer this. I think, for the benefit of this discussion, we're not going to get anywhere, discussing military might and stuff like of the China's potential invasion to Taiwan. All I will say is this. So unlike Russia, who's had Putin for the last 22 years, China at least used to have a system where the leadership cannot stay, and the entire leadership team turns over every 10 years. Now Xi Jinping is changing that. So you have if one person is staying on for longer and much longer than usual, then the chance of a unilateral decision by a single person becomes stronger, right? So all we can agree on is the longer this rhetoric keeps up, and the longer it's the same person in the office, the chance of Taiwan being invaded goes up. Although I don't really know, goes up to what percentage, right? Right now, I think it's pretty low. So Jake, do you have a target price target? How do you look at this this investment?
Yeah, I'll go over the valuation. And one more thing I just wanted to emphasize quick on the VIE structure is that the Hong Kong shares and Baba shares are on the same VIE.
Yeah.
The Baba is just an ADR of the Hong Kong shares, from my understanding. So if they got rid of the V structure, they'd basically be taking out their own investors as well.
Well, actually, not necessarily. See this, the accredited investor system here, right? Basically, ordinary Chinese mainlander investors cannot invest in Hong Kong shares. A lot of people didn't know that.
What do you mean?
They can't buy Hong Kong shares.
I can buy Hong Kong shares.
Yeah, you can, but Chinese citizens can't be. So you're talking about taking out their own investors?
Yeah.
They cannot.
Yeah.
Unless you're kind of like a credit investor, usually just like the richer individuals. Chinese individuals, like ordinary investors, can buy shares in Shenzhen and Shanghai, but Alibaba is not listed on there, right? Right now they're coming out with like a Beijing exchange as well. So just put things in context. I think the Hong Kong shares are owned by a lot of foreigners as well.
Yeah.
And ordinary citizens, if we're talking about politicians trying to not hurt their base, these are not the folks that own the Hong Kong shares.
Yeah. Okay. Yeah, so for my valuation, I got 19% revenue growth for next year, 13% for years 2 to 5, and then operating margin of 13%, and that's growing to 20% by year 10, because I think a lot of the segments that aren't profitable yet are going to become profitable. And with cloud revenue growing, I think that's also going to push the margin up. And then so that gives me 1211. So converting that to US dollars, that gives me 191 per share. And
in
that's
5
also
years?
that would be the fair value discounted back to today.
Oh, I
So
see.
you're saying it's worth $190 today?
Today, yeah. And then that's not including their 33% stake in Ant Pay or Ant Group, sorry.
Yeah.
So
What's your discount rate, Jake?
My discount rate for that was 6.7. I used weighted average.
Oh, the cost of capital. Okay.
And then that's going up to 7.21 by year 10.
I see.
And with Ant Group, I believe that adds like $20 to $30 per share, assuming it's valued at 100 billion. Where IPO, it was valued at 300 billion, but obviously a lot has changed since then. So I went with 100 billion, and that would give me 229.50 per share in today's.
Right. Okay. So I understand you use conservative forecasts, but the cost, the discount rate is fairly low, right? So obviously it's going to give you a larger number. And this, by the way, the stock deep dive is Jake's website, which is excellent. So the listeners can check it out.
Thank you.
Do you then assign margin safety on top of that price, fair value?
Yeah. Like for example, last week when we did Square, my fair value was basically what the price was, I think, but I wouldn't buy it just because I'm looking for a margin of safety on top of that. So with these numbers, gives me 229. I think my average cost is 129 right now. So that gives me a pretty good margin of safety.
And what did your valuation come out at, Nate?
Okay, so this time again, I didn't do like a DCF, but I compared it using value metrics to other companies. So if I could just share my screen real quick,
So
I'll do
Jake, you
that.
can just click stop sharing. Awesome.
Okay.
Yeah, then after Nate does his, I can show mine.
Yeah, and this is kind of my bear argument here too. So I looked at a couple different growth metrics. I looked at the past 5 years growth. Analysts predicted 5 years growth according to Yahoo. Last year's growth according to gross profit, and next year's predicted growth according to analysts on Yahoo Finance. And then I took a mean growth rate. I like including past growth with predicted growth rate because I think the past is likely to have some impact. Like I'm not going to invest in a company with a predicted 50% growth rate and a negative 10% growth rate over the last 5 years. That's just me personally. So looking at this, Baba actually had the lowest growth rate of any of these companies on the list. Although that might be because the average analyst was predicting Baba to have 0.0 or 0 growth over the next 5 years, which is part of how I got to that 15% predicted growth rate for Alibaba. It's also like Facebook is a lot cheaper, in my opinion, than Alibaba, and Google is similarly priced, but Google has higher growth. And then I broke this down by PEG. So PEG is the PE divided by the expected growth rate. And Alibaba came out with the highest number. Generally speaking, companies below 1 are considered to be companies with a good PEG. And
what numbers did you which year or which quarter did you calculate the PE? Because you're showing a PE of
I'm just using, I just went to the front page of Yahoo Finance for what they're currently listing to PES.
So
that is correct for the last quarter because it had, well, for the trailing 12 months of Alibaba, they have that $2.8 billion fine as well as a $4 billion
I see
impairment charge. So that's why it's 23 now.
Okay, so if you look at a normalized PE, the one I have on ticker, so probably get rid of that.
So what's the normalized PE?
Yeah, it's at the end of last year, December 31st, 2021, it's 13. And right now, March 11th, it's 10.
Okay, wow, that does change things a lot. So let's change that.
Well, the price obviously have come down quite a lot. Yeah.
So that gives us a PEG of 0.65, which is a lot better actually. That being said, ultimately, I think these numbers are actually pretty similar to other American tech companies. You know, like all of these then have a PEG or a good PEG. But I would rather the margin of safety in terms of the regulatory risk of an American company right now than say Alibaba. If I thought Alibaba had a higher growth rate or even a greater discount rate, I would probably be more interested in Alibaba. But in my opinion, like Facebook is the cheapest company here relatively, and Google is quite similar, and Amazon are quite similar, but with way less risk. So I'm a pass on Alibaba right now, personally.
Okay, I can share mine. All right, so I updated my growth rate, although my the last you know, when I did this was around I think May 2021. Back then I've assigned I think, you know, somewhere between 35 to 40-ish growth rate on the revenue. I've now changed it to 20 to reflect what has been happening last year or so. Now, to again saying a little bit of context, last year is particularly tough for China because they persisted with a rather incomprehensible zero COVID policy, which you know, is coupled with the real estate crisis. So when people's perceived net worth goes down and they're worried about losing their job because you know, the commerce has been stopped by zero COVID policy, they're unlikely to spend, right? There's a lot of stuff that's on Alibaba that's discretionary. Although you could argue like Cainiao, which delivers fresh groceries, is essential. So my approach is a little bit different than Jake's, and I actually go line by line. I start with a growth rate for revenues, and I project out that for 5 years, and then I just keep the current gross profit percentage, so 40%. I'm not assuming that I'm assuming that the sales would slow down, but the gross profit would stay. They still have a very dominant market position. And then they have these operating expenditures, for example, SG&A, R&D. They continue to invest quite a bit in R&D. Now, so my approach is basically, if they're growing 20% and they're resigned to growing at 20%, they're gonna probably invest 20%, like increase their R&D by 20%. Now, if they think they can grow faster than that, they're gonna invest more, right? So basically, I'm saying SG&A, R&D, these are all growing at 20%, and that gives me an operating margin. So I'm not taking a operating margin percentage and multiply by revenue. I'm calculating the operating margin directly. So then I go over here. I say, okay, so what is the terminal PE? I'm giving it 20. That's pretty low, right? That's a little bit higher than Facebook's currently, but it's lower than all the American big techs. You could say it, you can say it's lower, but 20% growth, 20 times PE. That's basically how I justify that number. So it gives me a terminal value. So these are some conversions from US to renminbi. Basically, my price target in 5 years is 235%, given the very low kind of growth that that seems to be happening in China. I do think it could be higher, but then I'm applying a very aggressive discount rate, right? 15%, because that's the minimum amount of return I need to hold this investment. I have been more bullish on earlier part of the year, 2021. But similar to Nate and Tom, I'm not giving up on it, but I do feel the government is suffocating a lot of these high growth companies. So using 15% discount of the present, it's about $117. Again, right? This is for 15% up year-on-year growth. And I do a little bit differently because we talked about Ant Financial, and actually Alibaba has a bunch of other kind of investments into other companies in China. These are not contributing directly because they don't hold like a big chunk of the company. So basically, then I add the fair value of those share of my price target, add the fair value of the equity investment to recalculate the market cap, right? So then I compare the market cap, and this is not November. This is I just updated this, so this is March 2022. So looking at their the fair value from the company through their operations and their income, plus the fair value of the equity investments. So that actually makes the investment much more attractive with margin of safety about 70%. So a big part of the value is from their investments. Now you could say that the investments, some are private. We don't know how much they're worth. I agree with you. So, but I think that gives me a slightly more comfort holding this stock.
Tom.
Yeah, in terms of valuation, I think that using the higher discount rate is always a better thing. That's one thing I don't like about a lot of the DCFs is using the weighted average cost of capital. I don't like that number. It's way too low of a discount rate, and there's too much. Yeah, like using a 15 or 20% discount rate, I think is a lot better, just for most companies in general, because I'm not aiming for a 7.5% return. So I wouldn't never use a 7.5% discount rate. But yeah, I think the, Kun's valuation is pretty good. I just think that at the end of the day, that regulatory risk is too great at any price. Because, the chances of it, like with most investments I make, I say to myself, what is the chance that this company is going to go bankrupt? what is the chance that this investment is going to go to zero? And in this case, regardless of how the company performs, there is a significant chance of it going to zero.
Because you think that the Chinese government might just basically do something like the online education thing, just tax it to death, or basically declare some part of their business not you can do a for-profit thing. So actually, rather than talking about generalizing this entire thing, I think a key part is Alibaba's cloud business, right? Because Jake mentioned, hey, we don't know why ByteDance dropped Alibaba. Maybe it's because they a significant part of their TikTok business is outside China, and they don't want to be associated with a cloud business that can ultimately be kind of basically be looked at whenever the Chinese government wants it, right? So maybe that's the reason. But that would mean
is there cloud business? Is there cloud business and a lot of these Alipay and stuff like that? Are they limited TAM only in China, right? Like, is there ever a plan to expand outside any of these businesses outside of China?
Or I think the Chinese market is going to be big. It's a matter of how much the government will let Alibaba monetize it, right? So I think that's the risk. Although the growth in the cloud business has not been great. I mean, the management is saying 30 to 40%, but I think last quarter they only grew like 20%. Is that right, Jake? I'm not too sure.
Let's see. I got it open here.
I think I remember from his presentation, most of the growth rates were under 20-25%.
Yeah, you wonder why, right? Like, why are the Chinese businesses reluctant to invest in the cloud? Is it because they feel like a recession is coming? They don't want to commit to these contracts, which is part of it why Alibaba's growth so low. But I think their Lazada business, especially the e-commerce in Southeast Asia, should be growing. I think it is growing very fast, even though it's still losing money on it.
Yeah, that's their main growth, is the cloud and the Lazada. I think the reason cloud is slower to grow is just because China is kind of catching up. They're way behind in the cloud segment compared to like North America. But I think over the next 5 years, that's why they were saying it's expected to grow 40% per year for the next 5 years or something.
Yeah, one thing I will say about China is their broadband connectivity is much better than Canada and the US. So it's kind of curious, right? Like, infrastructure is there. It's just like people hasn't start thinking seriously about leveraging the cloud to boost their business. But I think
do you think that the fear of the regulatory environment within China would prevent people from wanting to put their data on the cloud?
No.
Then storing
they have no privacy in China. Like, the government can already see everything. So yeah, it's when government says, hey, we need to protect the privacy, it's not from the government. It's like so to give you some context, there's a lot of the consumer data. This is why ByteDance is so successful in pushing out TikTok, is because all those data were just kind of like laying out there, like it wasn't even protected. So they can data mine to their heart's content and then build an amazing algorithm, right? So what the government is saying is that only us can we have that ability, but the private commercial enterprises cannot. So there's a lot of like privacy related regulation coming, but certainly they're not because the people don't want the government to see their data. It's the mindset in China. And obviously, the government in China is a lot different than the US.
So it's just a given for them. They know that the government is watching them.
Yes.
I've got to run, guys.
Yeah, me too. I was just gonna say to Tom, because it's weird because normally me and Jake are the Bears, and today Tom and I are the Bears. And I just want to say to Tom, is there anything that would make you buy the stock? Personally, for me, like, if I was less worried about the war in Taiwan, I would probably buy the stock. How about you?
I think if there was any sort of certainty from the Chinese government saying, hey, these are our rules ongoing, as long as you follow them, everything is good. But just the fact that they won't really give any solid guidance or clear outlined yes or no, we're going to do this or not. It's sort of, they leave everything as, hey, it's going to be just at our discretion through the future. If they were to give some more concrete guidance in terms of what they're going to do regulatory, then I would say, okay, now is the time to buy, because I think this company's future valuation all 100% rests on, is the stigma from the regulatory issues ever going to go away? If that stigma ever goes, this company is probably going to double or triple overnight. But other than that, unless that stigma goes away, I don't think this stock's going to do anything.
Yeah, part of the China's, it's been growing very fast, and you know the Wild Wild West thing can definitely apply to especially internet-based commerce, and this regulation catch up slowly. You know that's true everywhere. Although in China, you're gonna continue to deal with basically the government wants more control, so it's almost like a separate set of rules for them as opposed to others. We may just deal with continued uncertainty. I don't think like you're ever going to see the same legal system as in the US or Canada, so we just have to be ready for that. What about you, Jake?
Yeah, I think it'll take off. I don't know when. It's a long-term hold for me, but
so Jake, I have one question for you, similar to the question that Nate just asked me. Is there anything that would make you close out your BABA position at a loss?
Not that I could think of right now. In fact, right now it takes everything in me not to remortgage my house and put more in.
You're crazy. All right, guys.
All right.
Good.
Yeah, this was a good one. Have a good day.
Yeah, you too. Bye.
All right. Cheers. Bye.